Good morning. Welcome, everybody, and thank you so much for joining this conversation on the future of loss mitigation. We have some terrific expertise assembled here today. Over the last 15 years, thanks to a foreclosure crisis, a pandemic, and increasingly severe sets of disasters, our panelists are among the people who have helped to rethink and reshape the foreclosure process in response. So today we're going to hear how the learnings can be applied going forward. The first two panels will focus on two specific possible mechanisms, offering nuts and bolts insight and some emerging consensus, hopefully, around how we can better align the interests of various parties and still keep more people in their homes. And then Vanessa Perry and Lisa Sitkin, along with Bonnie Sinnock, will have the most important task of putting all this in context and helping us all stay focused on why it all matters. So before I turn it over, I'd like to go through some housekeeping. And the housekeeping tips are also on the slide. This event is being recorded. The recording will be posted online afterwards. You can hide captions or adjust your settings with the show hide caption buttons. And also, I should say, the speaker biographies are available online at urban.org. Throughout the webinar and discussion, all the participants will be muted, but we encourage you to put your questions and your comments into the Q&A box at any time to help keep the conversation lively. And then we ask at the end that you complete the survey, and you can also use social media as shown on the slide to communicate about the event. So now I'm going to turn it over to Karan Kaul, Principal Research Associate at Urban's Housing Finance Policy Center, to kick off panel number one.
Thank you, Yannicka, and good afternoon, everyone, and welcome to the first of our three panel discussions today on the future of loss mitigation. In this first panel, we'll lay out some of the issues higher interest rates pose for consumers and borrowers seeking to lower their mortgage payments when they hit a bump in the road. In particular, we'll discuss the difficulty servicers face in providing payment reduction when market interest rates have increased beyond or above the original note rate on the mortgage. So with that, let me invite my esteemed panelists to join the discussion by turning on their cameras. We have Michael Bright, who's the Chief Executive Officer with the Structured Finance Association, Kurt Johnson, Chief Risk and Compliance Officer at Mr. Cooper, Tom Land, Vice President, Agency Relations and Government Servicing at JP Morgan Chase, and our own Ted Tozer, non-resident fellow here at the Urban Institute's Housing Finance Policy Center. A couple of quick reminders, as Yannicka mentioned, the detailed speaker bios are posted on the events page, and the link is included in the chat for those who want to take a look. And finally, feel free to add your questions in the Q&A box as you have them. We'll try to get to as many as we can at the end. So what I'd like to do with this panel is to have all four of you take maybe 3 to 4 minutes for brief opening remarks. We'll first hear from Ted, who has actually written on this topic recently, and will set the stage by framing the issue and describing the problem. Next, we'll hear from Tom and then Kurt on a proposed solution that they've come up with, and they'll detail it for us here today. And finally, we'll hear from Michael Bright on how MBS investors are thinking about this and some of the other issues they're most concerned about. So again, take 3 to 4 minutes for your opening remarks, and then I'll have some prepared questions before moving on to audience questions. So with that, Ted, please take it away.
Okay. The reason this discussion is so timely and so requiring us to kind of open this up is over the last 40 years, pretty much falling interest rates has really been the foundation for the successful loss mitigation strategy servicers have used. They've really used two basic strategies. One, if a borrower contacted them was still current, had not missed any payments, and they knew they were in a financially challenging situation, they would do a stern refinance. Just do a rate and term refinance, not able to requalify them, and give them a lower payment. And at that point, they would chances are be successful because the lower P&I payment they got through the refinance process. If they were delinquent, what they would do is the issuer would buy the loan out of the MBS pool. They would reduce the interest rate to the current market. they would take any delinquent payments and forbear them by adding them to the loan balance of the loan and increase the balance. And then they would extend the loan term to either 360 or now Ginnie Mae allows to go to 480 months. And at that point, we would re-amortize the loan, create and calculate a new P&I payment that would be below the original principal interest payment. Even though their loan amount had gone up, their principal interest would be lower. And at that point, the issuer, the servicer, could put that modified loan into a new MBS security. And at that point, they'd be reimbursed for other forborne payments, and everything would be fine. The borrower had lower principal interest payment. The servicer did not have any of their funds extended. They were reimbursed for all their payments, delinquent payments, and they would move on. In today's world, the problem we have is the loans we've done over the last 2.5 years. We really can't expect rates to fall enough for any of these two strategies I talked about to really work for them. Because again, the loans cannot be bought out of the MBS pools, because the MBS pools are a source of cheap financing for the issuers. And if they're bought out of the Ginnie Mae pools, they have to raise the interest rates to current market because their financing costs goes up accordingly. So any solution we come up with, the loans can't be bought out of Ginnie Mae pools. They got to stay within the pools. Ginnie Mae reviewed its prospectus for their MBS program, and they determined that really, if the loan's modified, they really can't change anything that they're looking at in their system. I mean, all loss mitigation options are required to the fact that the principal balance cannot go up. You cannot add the delinquent payments to the borrower's principal. The remaining term can't change. So if the borrower's 2 or 3 years into their loan amount, you got to keep it at that original maturity. You can't extend it. And also the P&I payment that the servicer is reporting or is delivering as far as paying to the bondholder every month can't change. So basically all the original terms that Ginnie Mae saw at the time that you created the pool has to stay intact, which means that basically Ginnie Mae can facilitate this anything we do very quickly and very easily, but it really ties the hands of what the servicers can do. And the reason this is so important topic is our next panel, or we're going to have, is talking about forbearance. And the key thing is, with forbearance, we've got to find a way for servicers to be able to be reimbursed at the time that the forbearance period ends to the borrower. If not, financially, the servicers cannot find a way to finance those forborne payments. So finding a solution to this actually is critical to actually be able to use forbearance as a loss mitigation tool going forward. So again, looking forward to hearing what my panelists have to say as far as the solution.
Hey, so thanks, Ted and Karan, and thanks, Urban, for having me today. We really think this is a critical issue, and we appreciate you guys bringing awareness to it. So kind of build off of what Ted said. So really current the loss mid toolkit is really limited in terms of its ability to help customers with below market rates. So we think this is really true in the government space too. And when I say government space, I mean FHA, VA, USDA, and Ginnie Mae as well. When we're looking at some of the metrics, we think about 90% of the current outstanding Ginnie Mae issuance has rates at 2% or greater below current market rate. So the inability to provide rate relief really hamstrings a servicer's ability to help customers who may be in imminent default or default. So with this in mind and thinking about kind of economic uncertainty moving forward, Chase and really all of the industry has really been thinking through, how do we help these customers? And one proposal that's been gathering kind of momentum over the last couple months has been repurposing the partial claim for FHA or the mortgage recovery advance for USDA to supplement a customer's monthly contractual payment. So we're going to refer to this, it's being referred to as now as a payment supplement account, or a PSA. So you would house this account, the PC dollar amount as an account bucket on the first lien, and then draw from that bucket to supplement a customer's monthly payment. So really high level, let me walk you through this. So say you have a customer with a below market rate that comes in, they're in default, imminent default, and they can't get relief through existing loss mitt programs. You cure their delinquency by placing the arrearages in the partial claim. And then you calculate the payment reduction target. So here we're just talking principal and interest. So let's say it's 25%, and the supplement's going to last a term of 5 years. You would pull from that bucket that you created on the customer's account the 25%, and the customer would have to remit 75% of their P&I payment. So an example would be if a customer had a $1,000 P&I payment prior to the PSA workout, they would now be responsible for $750. When they make that $750, the customer or the servicer would pull out of that bucket $250, and that would be the full contractual P&I payment. And this gets back to a key point that Ted raised. When you have that full contractual payment, you can pass it through the Ginnie Mae, and you can execute this, we believe, while the loan is still pulled with Ginnie Mae. So there's no need to buy out because you're not modifying terms. A secondary benefit to this is the customers maintaining their below market rate. Just me personally being a consumer, if I had to go from a 2.5% or 3% rate and modify that to a 6.5% or 7% rate, there would certainly be some heartburn if you could even help me in that rate environment. So certainly some positives to this proposal. As we've discussed this with the agencies, FHA, USDA, Ginnie Mae, they all seem to think it's workable within kind of the framework, their regulatory framework. FHA has even gone as far to say that out of all of the proposals they've looked at, this one is the most feasible. And also in discussions with Black Knight and Sagent, from a system standpoint, we think this is workable as well. So we continue to develop this proposal with our industry partners. We're hoping in the next couple of weeks to really finalize some of these details and present a more full proposal to FHA. I think wherever we land, if this proposal ends up moving forward with us, or there's another solution that comes to the forefront, whatever solution we come to, it needs to be a permanent part of the loss mitt toolkit going forward. We're going to find ourselves in another rising rate environment in the future, and we want to make sure that we have the ability to help these customers. I think that's the key point, the key focus here is these customers, they deserve kind of the assistance that any other customer would get in a different environment. So I think we need to get to the point where we can figure that out. I think that's really a key focus here. I think I'll turn it over to Kurt with that being said.
Great. Thanks, Tom. And I'd also like to start by thanking Ron and Urban for having this conversation. And more importantly, I think I've been in the loss mitigation space for about 15 years now, since actually going into the Great Recession. And one of the great things that I've seen over the past 3 years through COVID is really the servicing industry coming together with the government agencies and with consumer advocates. And Urban's really facilitated that to kind of have these constructive dialogues about what can and can't work for differing rate environments. And I think we got to the CARES Act and forbearance as kind of a consolidated group very quickly. And I applaud everything that Urban's done to really kind of move that forward. As Tom said, I think the industry is gravitating to the payment supplement. A proposal we put forth to Ginnie was actually very similar in structure, but it was facilitated to be potentially easier for the servicers, and that it actually stemmed from an idea that Ted had put out in an Urban paper to really look at recast. But as Ted said earlier, you can't really do a recast within a Ginnie because if you lower the P&I in any given month, that doesn't work and it's viewed as a modification. And Ginnie really needs that scheduled P&I payment on a go-forward basis. So all a pay down does is really shorten the term for the customer. It doesn't really provide any monthly payment relief. So the concept was to, again, use the partial claim, much like the payment supplement, to pay down the balance of the customer's loan, then do a recast to the customer, and used that excess amount of partial claims in kind of a investment pool to help pay the scheduled payments that Ginnie Mae requires. And as Tom points out, 90% of customers are in a rate that is 2% lower than the market rates are today. And so you've got this ability, the spread between the remittance rate on Ginnie Mae securities and the rate that you can reinvest and earn income on, to really create that pool of funds to be able to make the scheduled payment on a go-forward basis. The advantage over the payment supplement is that this would be a true life of loan. You would recast the loan, and so it would be a reduced payment for the remaining life of the customer's loan. The disadvantage, obviously, is that there's a lot of complexities with creating kind of a pool of funds that would invest in market earning securities that would be able to make that differentiated payment to a customer, or sorry, to Ginnie Mae on behalf of the customer on a go-forward basis. And that the payment reduction versus that payment supplement that Tom really discussed is probably less. So you wouldn't have as much of a payment savings for the customer, but it would be for the life of the loan. But I think that the complexity with Ginnie and just having to coordinate various different resources, while it is, again, easier on the servicer because a recast is something that servicers do all the time, it became kind of unfeasible with Ginnie Mae. So I do agree with Tom that the industry's alighting on the payment supplement, which I think is a workable solution for everyone. And with that, I will turn it over to Michael.
Thank you. I thought those were all really good comments. I associate myself with a lot of things that were said, especially Tom's point about the fact that, we're thinking about future of a world where, this is a scenario worth considering. I mean, it's a pretty unique environment that we're in right now. It's kind of unclear where we're heading next year with recession, calls, et cetera, and a rising rate environment. So it is a unique moment. I completely agree that all the data we have is what to do with loss mitigation in a falling rate environment, and we potentially could be dealing with a very different scenario next year. That said, unemployment is still really low, like very, very, very low, and housing equity is very high, and so I think it's wise and prudent for us to be having this conversation, to be thinking through all the scenarios that we can plan for. But I also am hoping that, given that household balance sheets are in pretty good shape for the most part, especially when considering home equity, so the desire to stay in the home may be very different than where we were in 2009 type environment, coupled with the fact that jobs are, they seem to be plentiful, at least for now. And I know the Fed's trying to change that, at least on the margin, or at least change wage pressure from the unemployment rate. But hopefully the employment situation stays strong enough that we don't have to deal with, an epic series of foreclosure challenges or loss mitigation that put material strain on the system. So that's not to say it's smart. It's not smart to be planning for it. I commend the Urban Institute and everybody for doing this. I just hope that it's possible we don't have to get there in large scale next year if some of those other factors remain in place. We represent SFA, both issuer and investor and servicer, so we've got them all under the tent. But I've asked to give a little perspective, I guess, of the investor viewpoint. They've had investors are dealing with quite a bit right now. We're seeing, like everyone, seeing AUM get trimmed pretty aggressively as prices are falling in a lot of the investments. There's some political pressure on the investment community is facing with some of the ESG stuff. So, investors are dealing with quite a bit and sort of trying to sort their way through it. When you present them a hypothetical like this, which is something I'm trying to do, and I don't want to get ahead of them because it takes a minute, it can be difficult for fiduciaries to, really opine publicly or formally on a hypothetical situation, because they are fiduciaries, and that's something to keep in mind as we go forward with this. But I think that I really appreciate that Urban is bringing the investor perspective in the early stages of this, because I think that was maybe a mistake that was made a little bit in 07 and 08 really, I guess, '08, latter part of '08, early '09. Yeah, sorry, I'm just getting refreshing my memory. It took a minute kind of to get the investor perspective under the tent. And I think that there were some unnecessary policy mistakes made in that regard. So I think it's really, we really appreciate that you all are bringing investor perspective in early. At the end of the day, I guess the bottom line at this moment would be, historically, I don't see investors having problems with things that are thoughtful, permanent solutions, to Tom's point. So if we're going to kick around this idea with the FHA, and the FHA says it's operationable and we can price it and model it, it's at least something that I'm happy to facilitate taking to our members or discussing with our members where heads sort of start to explode and the system really breaks. And this is what we saw with COVID, is when we use temporary solutions, and the temporary solutions keep getting kind of extended while we're searching for real, meaningful, permanent solutions. That's where the investor community starts to say, listen, we don't love doing advocacy against solutions for borrowers. That's not really what the investors like doing. They want to have solutions and that are positive for the entire economy, but you can't price, you can't model, you can't forecast solutions that just keep getting rolled forward, or temporary patches is a better way of putting it, that just keep getting kind of extended. So the biggest lesson I have from the investor perspective coming out of COVID is, when we look at a solution, we should do it holistically, and we want it to be something that is something we can stick to and price and model, because that's really where the system breaks. Real quickly, one final point. I think it's good that we're talking about the future of loss mitigation and what loss mitigation is in a rising rate environment in particular. I also think that it's difficult. It's going to be difficult for some servicers to operationalize loss mitigation in a rising rate environment if they're feeling the strain of increasing delinquencies in an environment where there aren't refinances from current borrowers at the same time. And so the Ginnie program in particular has relied very heavily on issuers being able to take some of the refinance volume and allocate that P&I float to loss mitigation P&I advances in the delinquency space. And that's an environment that we're probably not going to be in if next year we see rising delinquencies with rates continuing to go higher, or at least staying sort of where they are. So that's a challenge that's really going to actually be canary in the coal mine. And I think that it's more than just a risk to Ginnie, it's a risk to the borrowers in the system, because it's difficult to do loss mitigation if you yourself are trying to put a fire out in your own house. And I don't think that all IMBs by any means are in a precarious situation. I think some of them are very well capitalized and have done a lot of work to be ready for this, but some haven't. And so that's just another concern that I would put out there, is something we need to talk about and consider. If borrower outcomes is forefront of our mind. I'll stop there for now. Karen.
Thank you for those wonderful insights. That was really good. Just to follow up with a question there, in terms of, Michael, you hinted at this, and the fact that there are forecasts of a recession possibly next year. We'll see. I guess the question is, if you had agreement on this policy, which it sounds like there is at least agreement on this panel, and then you had a decision made at some point, that let's just go and let's do it. What would it take from an industry perspective, Kurt and Tom, as to what would the industry need to do? And I'm sure there is infrastructure that needs to be put in place, systems, processes that need to be put in place to actually implement it and roll it out. And then Ted and Michael, if you could talk about what needs to happen in terms of infrastructure at FHA and Ginnie.
Yeah, so I think there's a balance there for the implementation timeframe, right? And some of it could be driven by where the economy goes. So this is a really new concept in the servicing space. As I might be able to leverage some of the rate buy down work that has been done on the front end, but still, this is a new concept. So servicers are going to need to take the time to get it right. And plus, this is going to be a permanent loss mit structure would be the goal. So we don't want to roll something out real quick and just risk some of the issues that would come with that. So I think you need to balance the need to assist customers with the need for servicers to give them the time to get it right. Now, what does that look like exactly? I can't say. We know there's going to be development on the main servicing platforms, MSP, for example. But there's a lot of support systems that servicers utilize for loss mitigation too. So that's going to take development as well. And kind of turn times and development enhancements to these systems kind of runs the gamut throughout the industry. Generally for large shops, large banks in particular, it might take a little bit more time than some more nimble shops. So I think it's a good question. I don't think I have the exact answer, but really striking that balance between getting to the customers quickly, but allowing the needed time for services to implement is going to be key. And Kurt, I don't know if you have anything to add there.
Yeah, a little bit. I mean, the other, I think, key point, and Tom, I think you touched on a lot of the key things, right? That it's not just the core systems, it's all the ancillary systems as well. And then it's customer communication is really as well, right? This is a complex concept, and it is, it is a temporary payment solution, right? And so the customer needs to understand that. You need to have that well documented. You need to make sure that the remaining and available balance of that customer's payment supplement account is reflected to the customers on their statements. And so really all of those need to work in sync for this to be done correctly. And then, it's pretty easy to map out kind of the happy path. So if it's a 5-year payment supplement, and the customer has, to Tom's point, that $250 supplement for 5 years, and they make that payment for the full 5 years, and everything goes along perfectly. I mean, that's, I think, the easier thing for a servicer and for a customer to digest. The question is what happens when a customer redefaults, and thinking through all of those issues and what that looks like, and what an event of default would mean, how that event could be cured, whether those funds could be utilized, and again, explaining to the customer that while they are the customer's funds, they are specifically utilized for a given purpose. I think all of that needs to be figured out up front, so that we have sort of a coordinated effort, coordinated communication, and I do think all of that takes time. So totally agree with everything that Tom said.
Ed or Michael?
Well, again, from my perspective, the Ginnie Mae side's pretty much be pretty simple. I mean, the idea that Ginnie Mae says nothing's going to change as far as what's reporting to them. They're going to the same P&I and everything. So I think the Ginnie Mae side's going to be pretty easy. The FHA issue and the VA and rural housing issues, it's going to be more the fact that you're going to be relying more heavily on the partial claim process, and the question making sure they've got the infrastructure set up to be able to effectively continue to do partial claims and have the second liens that require for partial claims to be able to put on, in an effective manner for the servicers, so they can do that. Plus, again, the question is going to be is to making sure that FHA's got the process, and VA and rural housing to make sure that the second liens from these partial claims get rolled into all their actuarial reports and so forth. Because again, this is actually, you're increasing the basically LTV on these loans. So again, just making sure they have all the infrastructure for their risk management to be able to track these partial claims. Because again, the last year or so, they've done quite a bit of partial claims, but we've also been in an appreciating housing market. So now the question is going to be is in the future, when housing prices aren't appreciating the same way, that they have the infrastructure to make sure they're evaluating the risk of putting these partial claims. Since right now, partial claims can be up to 30% of the loan amount can be added to the principal amount. So I think the biggest challenge is the FHA, VA, and rural housing in getting their act together. Also getting back to the issue of the services, I think Tom made a good point. The thing as far as infrastructure, as far as how dealing with Ginnie Mae, is probably going to be pretty easy because it's just mainly the temporary buy downs we've done for years. The key thing is going to be the communication with the consumer and communications with the consumer. I think to facilitate the program that Tom talked about is going to be more of an aspect, I think, of making sure that the consumer knows what they're getting, and like Kurt said, how much is left on their balance of their loans and so forth, as far as the amount of money to supplement their payments. Anything, Michael?
No, I mean, I think you're right. I think as far as this exact program goes, I can't think of very much that would be a strain operationally on Ginnie. I guess we're again, if you take like a little bit of a step back and you look at what the rising delinquencies in a rising rate environment or a flat rate environment, where Ginnie could get pulled into it is, any P&I advanced challenges subsequent to this stuff. So, I think there's plenty of financing out there for MSRs and for P&I advances and a number of forms, but they all require Ginnie to be able to approve the structure and the arrangement. And Ginnie has some boundaries around what it can and can't do, and some of those, should be looked at and examined. There's some flexibility there, but that's where I think where if I'm thinking of where like Ginnie had where we could get pulled in, I think that it would be potentially in that piece while the FHA loss minute and servicer loss minute programs themselves are getting set up. And I think they are preparing for it. I mean, that's the impression I get. And I do, like I said, I think that one of the dynamics has been banks leaving this program or leaving the FHA program. Pretty, we've seen those numbers, but they're still willing to finance the asset and the P&I if they can get the right arrangement.
Thank you. That was wonderful. So I guess one, we talked about FHA at length a little. You guys alluded to USDA given their MRA program. I guess what's missing here is, VA. We know this program because it relies so heavily on partial claim. It's going to work well for FHA, it will work for USDA, and then you have VA, which doesn't have a partial claim. And so the question is, what could we do practically for veterans who, as you all know, are going to be facing some of these very same issues as once they hit these if you have a recession next year and people need assistance with their problem, what could we do? And we can go in the same order: Tom, Kurt, Ted, and Michael.
Okay, yeah, certainly a key component of this. So as you mentioned, VA doesn't have a partial claim program. They rolled one out for COVID. Operationally, it was very complex, but I think the bigger issue is it was a financial drain on VA's program. So I think based on their experience, there's no plan moving forward to roll out a partial claim. So based in industry discussions and our discussions with VA, they're looking at leveraging their existing VA refunding. They've rebranded it as VA purchase program, which allows them to purchase a loan from a servicer, and then VA can service that loan as they see fit. I believe they use a sub-servicer for that. So that program exists today. It's not widely utilized. It's pretty cumbersome. There's financial exposure to servicers when they utilize it. So I think really it's not an efficient program. So VA is looking at revamping that, and the service and industry has provided some feedback to VA as recently as last week, even on what changes we'd like to see in that program. One, reduce financial exposure to servicers, compress review timeframes, simplify the processing. So, we know VA is having a lot of internal discussions on this. Hopefully they keep us involved and we get to a point where they can really scale up this program, increase use. We don't think a limited VA purchase program will really be that effective. We think if they can increase use, see penetration to help these veterans, we think maybe it's something they could utilize going forward for sure.
I think Tom covered all of the key aspects of kind of what VA is thinking about right now. I think, what I would say is important is, look, veterans right now don't have much of a program, period, right? FHA still has the standalone partial claim so that customers can get back into a performing status and keep the payment level at where they were and keep their existing below market interest rate. VA really doesn't have that since they turned off the partial claim at the end of October. So I think VA, it's really important for people to kind of understand where veterans are in this current rate environment. And I think it's important to start making sure that is recognized by everyone in DC, because I think right now we're in a situation where veterans, can't be helped without, as Ted pointed out, putting them into an above market rate, or at least a rate above where most of the veterans are today. And that doesn't do them much of a service. Even if you extend to 480 months and get some level of payment savings, they're still paying more in interest. And I just don't think that that's a recognized enough problem today. The other thing I would just say about kind of the standard refund program and kind of utilizing a balance sheet approach is that that's what the GSEs are really doing today, right? The reason that we aren't really talking about Fannie and Freddie is because their flex mods permit the lower of the market interest rate or the customer's existing rate, and Fannie and Freddie are balance sheeting those. And I do think that if rates continue to rise, right, I mean, I think everyone kind of sees the forward curve and thinks that rates are going to decline again kind of by the end of next year. But what if they don't? What if rates continue to rise, right? Are Fannie and Freddie, along with the VA, going to be willing to keep these below market loans on their balance sheet? So I do think that we need kind of continued dialogue. The one other thing that I don't think we've, as a panel, have really touched on is the fact that, in this kind of economic scenario today, unlike back in 2008, right? 2008, you had both declining rates, but you also had declining prices. So there was no equity. Customers today actually have quite a bit of equity. And I think we're going to need to talk about solutions that aren't necessarily retention solutions for a lot of customers as well, where they can do a sale of their house and realize some equity, and really getting that message out to customers before they start going through all the expensive foreclosure, which really eats away at their equity quickly. I think that's got to be something that's on the table as well.
I think from my perspective, I think the industry really needs to kind of support VA and try to explain to people on Capitol Hill and so forth how important these programs are, from the perspective that VA is really getting hit from certain different angles right now. They're in a situation now where people at VA have relied on the profitability of this program. I mean, the veterans pay more for their funding than actually the losses are. And those profits are going to support the rest of VA, which again, I think we need to educate Capitol Hill that at some point the veterans really this needs to be a benefit. It can't be a profit generator for VA. And then secondly, it's a situation where VA is getting hit, like I mentioned, from a couple different angles. I don't know if people realize, but VA, if you're a disabled veteran, you don't pay a funding fee. And VA tells me now over half the veterans don't pay a funding fee. Plus, Congress lifted the maximum guarantee amount about a year ago, which means that they have super jumbos that they're insuring now too. So the issue we have today is we need to educate Capitol Hill that even though VA may actually start being a cost to taxpayer or something, it's a benefit. And we shouldn't have the veteran having to be foreclosed on and keep it a profitable program. And I think that's the key. I think the industry needs to educate Capitol Hill on the fact this is a critical program for veterans, and it needs to do what's need to be done to make it a viable benefit for veterans, and not be concerned about how much money it's making for the government. And I think that's the biggest challenge, because VA, this program has never cost the government any money. It's always been a moneymaker. But between the issues of the large loan amounts, the amount of disabled veterans in the program, and now with this issue, a partial claim, my point is, yeah, it's possibly going to lose some money, but it's a benefit. The government should pay for benefits for its veterans. So I think a lot of it's education through Capitol Hill.
I think it's a really outstanding point. I agree on a number of levels. I mean, I definitely think that VA, I think we found ourselves under-resourced at Ginnie. I think VA felt that, orders of magnitude higher, and the number of veterans coming back from wars getting VA loans just keeps going higher. But I don't think that their lending programs saw the requisite increase in resources. I do think so I totally agree with Ted's comments on that. I don't know that VA posting a loss or whatever term we would use would engender quite the same political reaction as, let's say, FHA does it, for a number of reasons that just kind of go, I guess, in sort of partisan politics. That said, you're exactly right that this program has been a money generator, and that the department has had to rely on. And so making sure everybody knows that that was that was a dynamic that we all just accepted. But the flip side of that is that in a downstream environment, you can't always expect that no matter what, veterans are going to stay at 0.5% delinquencies. I mean, they are hit by the economy too. So that type of education, I think, is critical. Honestly, veterans have been such a recipients of massive solicitations for refinances and cash out, and some of the stuff's just been so shady over the last, called 7 or 8 years. I mean, we, collect those documents, collect them at Ginnie just to keep them on file, and they're just, some of them were borderline deceptive, if not actually deceptive. It's almost too depressing to contemplate a world in which all of a sudden that noise goes away, and when a veteran needs help, they can't even find somebody to offer them this type of loss mitigation because it's not a tool that's available to VA. So that would be that's too depressing to even accept, I think, as an answer. So I do think working with VA to solve it, and then working with the Hill to get VA whatever it needs and whatever political cover it needs to implement something like that is something I would encourage and also offer to be part of, for sure.
Thank you. So we have a few questions from the audience that I'm going to try and get to as many as I can. The first question, this is for Tom. In the proposal, you outlined the fund that the servicers would pull the 25% payment from. How sustainable is this fund, and is that infinite? I don't think it's infinite because partial claim is infinite, but talk about the sustainability of the fund if you could.
Yeah, not infinite. So the partial claim for FHA is capped at 30% of the UPB. It's at the time of initial default too. So for the life of that loan, the PC amount can extend beyond 30% of the UPB. So this is one of the things that, we've questioned FHA on, around just the data available around what does the outstanding PC percentage look like for the book? How many customers have their full 30% available, and then kind of down the line to bucket it out. But it's not an infinite fund. If customers are coming back around through loss mid and have utilized the majority of their PC, this may not be a viable solution for them. But in talking to some servicers who have looked at their books, and this has kind of been a little bit all over the place, and it depends on how your shop is set up. There does seem to be a significant amount of customers who have PC availability. So we think that would help with the ultimate penetration of this product.
Thank you. And then related to that, and I guess either Tom or Kurt, you could take it. There's a question on redefault rate projections from this proposal. You guys model it internally or can share any insights on that?
Well, I mean, like our alignment is similar to what our redefault projections are at other workouts with 25% payment reduction or 20% payment reduction. So we think performance would align with what we've seen historically with that kind of model. So Kurt, I don't know if you guys have done anything different.
Yeah, I was going to say exactly the same thing. So, we look kind of pre-pandemic recidivism rates with 25% payment savings. You typically see the recidivism rate in kind of the 18-19 timeframe, which is when you had good home price appreciation as well. So keep that in mind, because we may be going into a not so great home price appreciation environment, but we were seeing those at, the recidivism rate of those around 30%-ish. And we would expect to see kind of the same performance, but a lot of that's going to be really driven by where home prices go from here as well.
Thank you. So there's another question. I know we touched on this briefly earlier on servicing systems and the support that this payment supplement approach will require in terms of systems and other changes in the servicing space. I don't know, Tom or Kurt, if you want to add anything to your earlier remarks.
No, not really. I think we acknowledge that there could be, potentially somewhat significant development depending on how the servicers have their kind of proprietary loss mitt systems or support systems set up. But, we've included Agent and Black Knight in the conversations. They think it's feasible, but obviously it's a key component on it. So when we talk about that implementation timeframe, to go back to your earlier question, Karan, I think that's certainly a huge component of it.
Yeah, the only other thing I'd say is I think the various different investor remittance systems, because I don't know that everyone utilizes Black Knight and Sagent for what they're remitting to investors or what they're doing from a cash management standpoint are all being considered right now. I do think that they need to be brought into the conversations as well, because I do think that there's a decent investor remittance component to all of these proposals.
So another question, and this one's around, we're going to have a panel on consumer, how this affects consumer later on. But sort of, if you could talk briefly, obviously, as you mentioned earlier, this is a big change, a new program. Consumers, need to understand it. It's going to be complex. Some education is going to be needed. So just from, again, Tom or Kurt from a servicer perspective, and Ted and Michael from FHA perspective, what does a servicer need to do from your standpoint to make sure, the potential for confusion and complexity is minimized? How are you thinking about that education piece, that counseling piece upfront? And then on the FHA side, Ted or Michael, what is the role of FHA going to be in terms of, what requirements, if any, should be there that should be put out before this program is finalized?
Kurt, you want to go, since I feel like I'm stealing all your answers?
Sure, I can start, and then I can feel like I'm stealing your answer, Tom. I think it's really important up front to make sure that the consumers understand what this is, right? That the payment supplement is exactly that. It is utilizing the partial claim to help them reduce the payment for a specified period of time, but that money is still ultimately owed to FHA, right? This is a second lien that the FHA is going to put on the property. And so it's not sort of a gift. It's not a, it's not a payment forgiveness component because it is part of the principal. It is still the principal that they would ultimately owe, but this is not going to change the amount that they owe on their debt, and making sure that they truly understand that. And then, like I said, also communications about what this looks like under the event of a redefault, right? Partial claims, as Tom pointed out, are limited to 30% for every customer. So when you utilize this, you're utilizing their availability down the road if they do hit another roadblock, and that could impact what they are able to get in the future. And so really having those communications up front with the customer, really making sure that they understanding that this is a temporary program, understanding that the utilization of the partial claim is limited. All of those are very confusing topics, right? And I think the more straightforward, the more consistent we can be as an industry in getting all those concepts across to consumers, the better we will be served as we roll out this program.
Thank you. Anything to add, Ted, Michael, in the remaining 1 minute that we have?
Well, what I was going to mention is I think not so much FHA, but the key thing is going to be the CFPB. And I think servicers also are going to want to see if they can have some sort of standardized reporting on all this, because again, you have Fannie and Freddie doing it, VA doing it, rural housing. And I think the key thing is going to be get some sort of standardized reporting that CFPB is comfortable with. And that's going to be the critical thing. Because I think the last thing services want is to have, 5 or 6 different ways of having to report this stuff, depending on who the credit answer is. So I think we need to come up with a standard that CFPB can kind of standardize across all credit answers.
Investors love standardized reporting. Final statement. Thank you. I agree with that.
Thank you. That was wonderful. I want to thank all 4 of you for sharing your insights with us today. I think there's a lot from this panel that we're all going to take away and sort of work and see how much we can advance the ball on this proposal, which I think it's great, and it's going to result in relief for consumers as rates rise. But we are out of time, and for the next panel, which is on forbearance, I'm actually going to be handing things off to Bonnie Sinek, who is the capital markets editor with the National Mortgage News. So Bonnie, please take it away.
Thanks, Karan, and thanks to all the speakers on the first panel. We're going to turn to this topic of normalizing forbearance, and I'm going to ask all the experts from that panel to join me on camera. With me today are Stephen Bailey, Senior Managing Director and Chief Servicing Officer at PennyMac, Meg Burns, Executive Vice President at the Housing Policy Council, Lori Goodman, Fellow at the Urban Institute's Housing Finance Policy Center, and Brendan Kelleher, Associate Director, Loan Administration at the Mortgage Bankers Association. We're going to kick things off today with a few minutes of introductory statements from each of our panelists. We're going to have a little discussion about the topics raised and others pertinent to the forbearance's future. And then we're going to leave a little time for potential audience Q&A at the end. So I believe that Lori wanted to start this off.
Yes, thank you very much. Thank you all for joining us today. And thanks very much to Bonnie for moderating this session. The COVID-19 forbearance program has proved very effective. My co-authors, Alexia Alexandrov, Ted Tozer, and I propose in a recent paper, Normalizing Forbearance, that this program be extended in more limited form as a permanent addition to the loss mitigation toolkit. What does it do? Under COVID forbearance, borrowers are able to pause payments for up to 12 or 18 months, depending on the forbearance start date. The borrower is able to enroll in the program by attesting to a COVID hardship. The missed payments do not count against one's credit score. When a borrower exits forbearance, the servicer asks the borrower if they can make a higher payment than they were making before. Most can't. The servicer then asks the borrower if they can resume their current payments. Many can. The forbearance balance is deferred and added to the end of the life of the mortgage. If the borrower cannot make their current payments, they are then considered for a modification. While forbearance has always been a part of the loss mitigation toolkit, prior to COVID, it was rarely used as borrowers had to repay the money relatively quickly. The ability to defer the payments to the end of the life of the mortgage was permitted only for natural disasters. The COVID forbearance program has been very successful. Black Knight data indicated that out of the 8.2 million borrowers who enter forbearance, 85% are current or paid off, 10% are still in forbearance or an active loss mit, 4% are in delinquency, and 1% in active foreclosure. These numbers are an order of magnitude better than expected, even taking into account the huge amount of home price appreciation over the COVID period. Nonetheless, these programs are COVID programs. For FHA loans, the forbearance program ends when the state of emergency ends, currently January 11th, 2022. The GSE program has no definitive expiration date. It seems reasonable to think of what a post-COVID version for standardized forbearance might look like. We propose one in our paper. We allow up to 4 months of forbearance with documentation for 4 easily documentable events: unemployment, a medical event that qualifies under the Family Medical Leave Act, the death of a borrower or co-borrower, and divorce. We understand that forbearance works best for temporary hardship, which death and divorce is not. However, a few months pause can allow the family to more fully appreciate and evaluate their economic situation going forward. Under our proposal, default does not need to take place before qualifying for forbearance. Because this forbearance is short-term in nature, the delinquency would not count against one's credit scores. This was a starting proposal, limited in scope to gain support. Note that 4 months of forbearance could be extended, the documentation requirements could be relaxed, and/or the range of events covered could be expanded if the program were a success. We believe for these 4 qualifying events, forbearance should be at the very top of the loss mitigation waterfall. Servicers are currently required to attempt to make live contact with a borrower within 36 days of delinquency and making contact to inform them of their loss mitigation options. In addition, current rules require borrowers to provide written notice within 45 days, encouraging the borrower to contact the servicer. We would amend these rules to put forbearance at the top of the waterfall and make it clear it's the best course of action if a borrower qualifies. One of the strengths of COVID forbearance was that the borrower did not receive a hit to their credit score due to temporary disruption in income. We would ideally require the servicer to try to at least twice to make contact with the borrower before reporting the borrower as delinquent to the credit bureaus. We show in this paper that under very conservative assumptions about the success rate, saving a relatively small portion of the loans that would have gone from forbearance into foreclosure, and recognizing that it would spur more use of forbearance would still be net present value positive, both to the holder of the mortgage credit risk as well as to the borrower and the community. Note that by cutting the number of borrowers that eventually end up in foreclosure, it allows us to open up the credit box at the front end, allowing for higher credit scores or lower debt to income ratios or loan to value ratios. It would also help close the racial home ownership gap. It would be a real shame not to take advantage of the valuable infrastructure of the existing forbearance program by making parts of it permanent. We have put forth a specific proposal. We hope that as others think about it, they'll find ways to modify it to make it even more useful. Thank you very much.
Thanks, Lori. I believe Meg wanted to weigh in next with her opening remarks.
Yep, excellent. Thanks so much, Bonnie. And thanks to Urban for holding this event. It's great. The first panel was really super. So I agree with Lori's overarching position. Forbearance has been incredibly successful over the course of the pandemic, and clearly forbearance needs to continue to be an option available to consumers in need. As she said, it was available in other forms prior to the pandemic and definitely needs to be available afterwards. But that said, I want to point out that forbearance needs to be used judiciously. It needs to be used when it is the appropriate form of assistance for the situation. So to explain, I want to hit 3 quick points. 1, how forbearance factors into the waterfall or the hierarchy. 2, temporary versus permanent forms of assistance. And 3, borrower communications. So first, the waterfall. So Lori says that we should put forbearance at the top of the waterfall. I would actually like to suggest that it is the initial servicer borrower engagement that really should trigger the solutioning process, and that solutioning process should reflect the borrower's situation. So the concept of a waterfall or a hierarchy of loss mit options, it's generally applied after the servicer and the consumer sort out the borrower's financial situation and the unique circumstances. And so one of the most critical things to discern in that conversation is whether the borrower's hardship is temporary or permanent. And so maybe this is a matter of semantics, because Lori certainly talks about how forbearance is a temporary solution. But for me, this concept of putting it at the top of the hierarchy is not exactly how I would think of it, because to me, the solution really depends on the situation, whether the borrower needs temporary payment relief. So that brings me to my second point, which is forbearance is a temporary form of assistance, and it's important that we don't lose sight of that. The reasons I want to emphasize that is because, for one, as she mentioned, as was mentioned in the previous panel, during the pandemic, we saw this very extended forbearance. 18 to 20 months of missed payments can add a substantial amount of accumulated arrearages to that outstanding loan balance. And it's much more challenging to shape the solutions to address that situation, in a permanent way. Even without the high interest rate environment that we were talking about in the last panel, it's just much more challenging with a lot of accumulated arrearages. So as we think about the use of forbearance in the future, we should definitely continue to think about it in shorter forbearance periods. Lori obviously is talking about 4 months with this proposal. The norm has been 3 to 6 months. In the last crisis, we extended unemployment forbearance up to 12 months. But the determination about that appropriate period, again, needs to be tied to the borrower's situation. How much time do they really need? Is it time to find a new job? Maybe that is 3 to 6 months. Is it a shorter period to sort out their situation in a disaster? Maybe it's only 1 month is needed. Maybe we put them on a 3-month forbearance with 1 month check-in so that you can cancel the forbearance as appropriate because the borrower is back on their feet. The other question is, does the borrower really need full payment relief or simply reduced payment over some period of time? The bottom line when thinking about forbearance is that it's really in the borrower's best interest to find a resolution quickly and to have the fewest number of missed payments, because that makes, as I mentioned already, the calculation of that permanent solution easier, but it also allows the borrower to retain their equity. And Kurt mentioned this in the earlier panel as well, that, home ownership is in large part about wealth building. We want them to retain their equity. We don't want them to use it up with missing payments if they don't need to. So I say this all because obviously, as Lori pointed out, the Urban Institute paper speaks to death and divorce, medical hardship, unemployment for consideration. But in some cases, moving straight to a permanent solution where you would receive some form of debt restructuring, a loan modification that will change the profile of the loan and reduce the monthly payment, that might be better and without the need to incur those arrearages. For example, death and divorce may be this way. It might be best to move to a permanent solution. So this brings me to my third point, which I have no doubt others will also highlight, that connecting with the borrower at the outset of his or her hardship is really critical. Establishing contact to make that determination about the borrower's needs is really essential for finding the most efficient and effective loss mitigation strategy. There's been some talk about automatic forbearance sort of swirling around in DC as a result of the CFPB RFI, putting a borrower into forbearance without that contact and without borrower consent, frankly. And I'd like to suggest that this approach could be detrimental for if a borrower is really in need of permanent assistance, and the forbearance would frankly present an unnecessary delay. We shouldn't want to create a situation where the loan balance is getting larger as a result of accumulated arrearages if we can avoid that outcome and move the customer to that permanent solution. So those are my 3 points. I personally would prefer that we not think of forbearance as at the top of the hierarchy per se, but instead as a temporary form of assistance that's used when it's appropriate. And that determination should occur during that initial communication between the borrower and the servicer. So with that, I'll turn it to Steve. Thanks.
Thanks, Meg. And thanks to Lori and crew for writing a paper. I think a lot of times you just talk about generalities and you don't ever really get to solutions until somebody has the courage and the foresight to actually write up a specific proposal. So thanks for that. I will probably sound like I have violent agreement with Meg on a lot of these things. Part of that, I think, is just a long history of dialogue between Meg and at least the servicing industry, and a lot of these topics have been discussed before. I'll try to focus a little bit different, but there might be some overlap. First of all, I would talk about what is positive about forbearance. Meg talked a little bit about some of the challenges. I share a lot of those things, but one of the things that I would view as positive in the proposal is the idea of aligning a specific amount of forbearance with a specific type of problem in the household. So this idea of 4 months rather than 6 or 12 or 18 months, I think is positive to the extent that you are working with a homeowner and you're specifying early on in the delinquency that there is a specific problem. It is unemployment, or it is divorce, or whatever the situation is, to have early understanding between both sides on what the specific problem is, somewhat leads you to the right discussions about what the resolution might be. I think this concept of a timeout, as long as it's an appropriate period, is a good thing. It allows a homeowner maybe to stop getting harassing calls or communications that aren't really acknowledging that both sides know that there is a problem, and instead both sides should be working on what is the resolution and what kind of solutions then might fit the resolution that the homeowner is able to come up with. I think that in some cases, foreclosure timeframes are very short. in some states. I think there's around 20 states where from the day you miss a payment until the day you might be out of the house is less than a year. And I think a formal act of forbearance that's agreed to by the investor allows you to move out the timelines a little bit. Certainly that amount of time is not equal throughout the country. There are certainly different timeframes in which foreclosure takes place between the various forms of foreclosure in the various states and their backlogs or their various rules that you have to go through. But I think adding some amount of time in states could be a positive thing, not just for homeowners, but sometimes for investors where there is a loss position out there, a little more time for a customer that actually could resolve and resume making payments would be a positive thing. A couple of things on the other side. I worry about the credit being masked from the very beginning as if nothing ever happened. I think there's a big difference between a disaster forbearance and the pandemic forbearance, where there literally was nothing a customer could do to avoid it, where we all agreed that credit protection, because of the uniqueness and the unavoidability of that, seemed very appropriate. When you're dealing with things, though, like unemployment or divorce or other things, you got to be careful not to undermine the credit scores of the industry, because they're used again to rely on somebody extending credit in the future. And although you want to offer some amount of protection, there has to be some kind of balance, so you're not destroying someone's credit and you're rewarding them for coming forward and you're rewarding them for having conversations, but you aren't trying to make it look like the delinquency never occurred at all. As Meg said, the real issue is to match the amount of forbearance and the timing of the forbearance to be short enough and to encourage discussion about what the longer term solutions are, which we heard on the first panel. There's a number of challenges with those longer term solutions. Right now, though, look, I think if we heard nothing, our enemies are inflation and interest rates. Inflation because it's causing people to miss payments a little bit now. Interest rates because the easy solution of lowering your payment is gone. But our friends are employment rates. So people that might lose a job, if you give them some amount of time to recoup, they could become gainfully employed again. And our friends are LTV. So as long as you don't use up all the equity waiting, LTV can help an investor not be in a loss position, and homeowners might have another solution, I think, which Kurt referenced early on, which is it might be after enough time to discuss things and think through their options for those that have an equity position to be able to sell for profit and resolve their delinquency that way could be the best solution for homeowners and for investors. And I'll stop there and hand it over to Brandon.
Thanks, Steve, and thank you, Lori and Urban, for hosting this panel, and to the panelists. Happy to be here. I think this is a great discussion, and I echo similar sentiment that Meg and Steve and even the prior panel highlighted, which is, we're thinking about the future of loss mitigation, and it is appropriate to think about the lessons learned. And so I'm excited that we're having this discussion. I'll keep my remarks very brief, because I'll just say I echo and agree more along the lines with Meg's position of forbearance, but to just put a fine point on it is just agree with Meg and Steve that forbearance is certainly a useful tool. It's a temporary, for borrowers who have a temporary hardship, to help drive engagement and contact. I think the point that I would like to make, or just wrap it all up, which is to say one of the lessons learned from COVID that we saw was the industry's collaboration to drive education. So we saw for example, the Not Okay, That's Okay campaign as one example, but the idea of industry coming together to help educate borrowers on not just forbearance, but what are the solutions available? How do they work? What are the next steps? What is appropriate? But ultimately what it did was drive engagement, consumers' engagement to the servicers to drive those conversations and have those conversations so you can understand and identify the best next step for the customer. And so we alluded to the RFI and that we all responded to with CFB just last week. And, we echoed a similar sentiment, but I would say that in short, our message was, reducing regulatory burdens, right? So we talked about letters when you're on forbearance, sending letters when you're delinquent. It just adds to confusion, but ultimately it was about reducing regulatory burdens so that I would say servicers could do what they do well and drive outreach strategies. So communicating with borrowers to get onto forbearance and promoting what it is not. And ultimately helping educate borrowers about forbearance, they're also trying to drive education and outreach strategies for those customers who are not engaged, which is also important and that we learned from this COVID pandemic as well. So just echo exactly what Megan and Steve said, and that's it. I'll put it there for now. I think back to Lori.
Back to Bonnie.
Yeah, thanks so much for those opening remarks. I wanted to start off talking a little bit about a theme that came up in the first panel, which was the investor community. How can they get their arms around this? Are they going to embrace this? Is the data on forbearance compelling right now? And I think Steve said he might be able to address some of this.
Sure. So again, I think one of the issues is the investors in general, when they're looking at any loss mit scenario, they're wanting to look at all of the scenarios. So they first start looking at, well, am I in a loss position today? So is there equity? Do I think I would lose more money in a foreclosure scenario because of the equity position and the inevitable downgrading of the property as you go through the foreclosure process? What does that number look like? And when you establish that number, that sort of becomes your budget then for, well, how much of a loss can I experience not foreclosing and have it end up being better? So I think really any solutions that end up with a better scenario, and investors in general start off with the back of the envelope believing that, well, that's got to be better than the other solution. But we have to remember, though, is it starts with what is the loss position? When the loss position is zero, investors tend to be a little sketchy on whatever those other solutions are. Now, obviously, everybody wants to have good human experiences through homeownership, and you want people to have adequate time to resolve their situation. And some of that is just about the broader experience of homeownership, and it shouldn't be you missed a payment, you're out. So in general, you want the homeowner experience to be good. But I think that initial position is very unique today. We have more equity than we've had in the past, certainly related to the great financial crisis, way more equity positions now than we did then. It's a little tenuous because I said before that loan to value is our friend. It is a fickle friend, and it can turn the other way and start moving against you. And when that happens, it's not just that the LTV is compromised, it's what is the direction of that LTV. If it is going down, investors tend to move the other way and want to be more interested in loss mit solution because of the unpredictability of the timelines related to that. So I think that's the position I would start off with. That you have investors are very supportive of solutions that are NPV positive, but it starts off with what is the loss position and what's the forecast of that loss position.
Thank you. I didn't know, I think Lori or Meg, if you had anything to weigh in with as far as the data that's out there right now, what do you think that'll be compelling when investors look at the forbearance data we got from the crisis?
Yeah, I think the forbearance data from the crisis is unbelievably positive. Basically, you've had 85% of the foreclosure of the forbearances resolved. only 1% of those borrowers are in foreclosure. I mean, only 1% of borrowers who selected forbearance are in foreclosure. In addition, I think there's a rich literature. It's increasingly showing that disruption, that income shocks are the biggest reason why people actually go into foreclosure. So there's a piece by Ganong and Noel that shows that 94% of foreclosures occur after an income shock. 70% are solely from a drop in income, and 24% are from double triggers. There's some very nice work by David Lowe of the CFPB that shows that unexpected expenses, job loss, large debt payments, illness, disability, or death are the 4 major difficulties leading to default. So, I mean, income shocks play a huge role in this. The other thing, I wanted to add one thing to Steve's excellent answer, and that's it's important to realize that not all investors are created equal. Agency investors really aren't concerned about credit risk. I mean, it's in some sense, FHA, Fannie, Freddie, VA are bearing the credit risk. They're really concerned about interest rate risk and how definitive their payments are. And I just wanted to, I'm very sympathetic to Meg and Steve and Brendan's argument that you really do want to customize to each borrower as much as possible. But I also want to re-echo Michael's comment from panel 1 about standardization, and I'm honestly not sure where the right balance is, but I did want to bring up that issue. Thank you.
Can I say one thing that I want to repeat something that Michael said on the first panel as well, not about standardization, but he pointed out that the temporary nature of the forbearance is one of the things that does make investors nervous, and particularly with the CARES Act COVID forbearance that went on and on and on and on, because it does make you wonder whether or not you can find a permanent solution that will work. And particularly in this interest rate environment, now we're concerned that the accumulated arrearages in conjunction with these high rates make it very difficult, if not impossible, frankly, to find permanent solutions where the borrower gets a reduced monthly payment. And so, to me, that actually is something, again, that reinforces, forbearance should be viewed as a temporary form of payment relief that should be used judiciously as necessary.
Yeah, I have a comment, and I don't want to repeat anything that Michael said, just to be clear. So I 100% agreed with the forbearance figures that Lori was referencing during COVID. But I want to make sure we're clear on, there were 2 very different things about that particular forbearance and where we sit right now. The first one is the thing that needed to be resolved was a national thing. We needed, for whether you're a masker or a non-masker, we all wanted for COVID levels to dissipate and for people to return to office, return to work, businesses to come back. And there was a very foreseeable, a group foreseeable energy that was saying, okay, we're all in this thing together. It's the same thing. And we believe the resolution of that thing will bring everything back. That granted this herd forbearance mentality that worked very well. The second thing, really important, was the long-term solution to resolve all that forbearance was rate reductions, because rates were so far below the standing note rate. So that the forbearance herd mentality going in was part of it, but the combination of, we all knew that there were these lower interest rates sitting there ready to resolve and wave all these people through to the solution. Where we sit now, it is not like that at all, as we heard from the panel in the beginning. So you got to be a little bit more careful. Again, I really like the idea of tying, you're unemployed, you're going through a divorce, you guys are resolving the death of a borrower, and attaching those to these forbearance pieces, but then starting the dialogue immediately with those homeowners on what is it you need to do? What kind of income do you need to make in order to reserve? What programs are available to you today? And having that dialogue early so that people can be focused on that resolution. And if selling of the home is the right option for the homeowner, then you don't sell your home in a day. You don't decide to sell your home in a day, and you don't execute it. Getting people to think about that very good option early when interest rates are where they're at is an important discussion.
All right, thanks for that. I think the other thing that was interesting is you brought up the CFPB RFI, some of you, and I wondered if we could talk about one aspect of that, and then we have some audience Q&A coming in terms of a lot of what they propose in that RFI kind of seems like it would change the prepayment profile of the loans. So I wondered if there were any thoughts. I think one of the letters mentions that you want to have kind of a dividing line between refinancing that helps the borrowers and churning. But I wondered if people could talk about that a little bit, the prepayment aspect of it. If not, we can move on, but that was one thing to comment.
Sure. So one other program that we've advocated is actually sort of a more streamlined refinance program as well, because you look at who hasn't refinanced during the crisis, and it's disproportionately lower income borrowers, disproportionately Black and Latino borrowers, disproportionately smaller loan balances. So having the CFPB sort of amend the ability to repay restrictions for for refinancings would be extremely helpful. You're actually reducing the default risk. You're reducing the risk to the credit risk holders substantially, as a lot of studies have shown. Yes, it does have a marginal impact on investor prepayment profiles, and they might charge a little bit more for that at the front end.
So Bonnie, could I answer the question, not in terms of refinances, but in terms of the loss mitigation and the streamlined loss mitigation that was really made not only available, but became sort of the dominant approach during COVID. So the CFPB RFI actually asked some questions about that. And what's interesting is that the existing regulatory X construct is based on this concept of a complete application coming in from the customers that is then evaluated to determine what kind of loss mitigation solution is best for them. And over the course of COVID, of course, we moved to more streamlined options. And frankly, there are variations on that. There are the simple borrower attestation, verbal attestation, which we saw with the CARES Act forbearance. There are cases where there's a borrower attestation, but there's some form of validation. There's some sort of documentation that comes along with it. And then there's the documentation on the income situation of the customer, where where the servicer performs a full evaluation for what kind of a solution is affordable to that customer. And because the construct that exists in the existing Reg X is around a complete application with information submitted, the CFPB has had to grant exemptions to their own rules to accommodate the COVID type solutions. They had formerly offered exemptions in the past as well, but we would like to see them actually rethink that framework, rethink Reg X, so that it doesn't rely on this kind of a construct. We think in the interim that there is room for interpreting what exists in Reg X right now to permit streamlined, but we think it would be smart for the CFPB to actually rethink the whole structure to try to better accommodate the approaches that are used in the loss mitigation space.
Yeah, for what it's worth, I'll just chime in and just say, yes, that's a similar approach that we took. We echoed a similar proposing amending Reg X to allow for the streamlined long-term solutions. But going back, and this isn't necessarily directly to Bonnie, your question, but in terms of the when we talk about regulatory burdens and going back to forbearance, sorry. One of the things we talk about is in our letter about how the conversations that you have, right, what defines a loss fit application could define the conversations you're having could define an application, therefore trigger letters and notices. And so we echo a similar sentence, ask the Bureau to rethink Reg X for that, because what you're trying to do with forbearance is drive engagement and talk to the borrower, help them, but not confuse them. So anyway, we said something similar. Meg.
So Bonnie, I would just add one little point, and it's not so much about the concern about prepayment speeds. I think it's more in line with where Meg was going, is to think about streamline refinancing as a longer term solution for lots of different things. And if a person is in trouble and refinancing is the solution, it can come in various forms. One of the challenges you have today is the credit trail of somebody who was modified is not that clear in the way that credit is reported to the broader community. The servicer may know, but whether or not people are able to pick up on the triggers that there was, they can certainly find out if there was a delinquency that was marked. But if there was a forbearance and then there was a subsequent modification, that's not always super clear in the credit trail to the broader community. And if you are a person that comes in and does a streamlined refi, there are some rules that you're supposed to have not redelivered or not delivered unless you waited a certain number of payments. And I think that lack of clarity has created some unintended violations of those regulations that I think, for different lenders out there, there was no malintent. They just, you couldn't see in the record what was out there. So I think we got to find the balance between, again, rewarding people that come forward, are letting you know that something's going on in their situation. They work to resolve that situation, really showing that they are, certainly that is a much better borrower to think about in the future than somebody who made no attempt to contact you and went straight down. Trying to find the right record to leave so that a future creditor can understand that, consume it, and then if it did involve any kind of restrictions in delivering that in the secondary market, that people would be playing on the same level field with that.
Okay, thank you. I think that'll kind of help us move into our Q&A portion. We're getting some audience questions. One is about handling, in line with that question about how do you maintain the record on these loans. On the front end, there was some experience with the communication with the servicers where the homeowners, they were in forbearance, but they continued to get collections calls. And the questioner is asking, can that be fixed? Is there something that could be done to adjust the systems to address that? I don't know if any of you can take that question.
Yeah, I can take that. So look, I think there are a lot of rules out there. There's investor rules, there are federal rules, and there are state rules. It's not like they all got together at a party and said, hey, let's align ourselves to make sure that this is super clear and everybody can follow it. They come at different times and they come with different motives related to those rules. I think all of them are conceived with really good ideas in mind. Either an investor trying to protect their interest, or some legislator or an activist trying to protect homeowners. They're all good. I mean, it's just they run into each other, and some of them people have scars from past investigations. Maybe a state regulator came in and said, you will never do this in state X, and so a person says, it doesn't matter who said what, I got burned on this in the past, I have to keep doing this. I think that people are trying to work together more and more, especially at the federal level, trying to align these things more and more. I think the systems are getting better and better. There are sometimes timing issues where a flag comes on in the morning and it didn't get updated, and somebody calls in the afternoon or something like that. But I think the answer to that is more dialogue, especially between regulators. And again, to the extent we have some good rules from CFPB out there on contact timing, I think to the extent that investors are understanding about these things, you can avoid trouble on that regard. But I do think that a lot of it is just based on there's so many cross purposes, and there is still work to be done in order to clean that up. But most of that work, I think, is in notifications that are required, not so much phone calls that are required.
Thanks. And we have another question kind of in line with the consumer conversation, which we'll get into in our next panel. And I think this came up in our pre-discussion a little bit. We were asked, what training do you feel would be required for housing counselors in this context? Should they be included in the conversation around the future of loss mitigation? I think, Brendan, did you have some thoughts around that?
So not exactly, but that's okay. And I say that on a personal note. I have not worked with housing counselors per se myself, but I know they're valuable to the industry, and I know some of our members do work with housing counselors. I think the short answer is, and definitely want to hear what others think. The short answer is, and as we talked about in the first panel, loss mitigation can be complex and it can be difficult to understand. And it's not necessarily on the borrower, or we shouldn't assume that the borrower simply understands everything, even from what servicers say or communicate for the notices that are sent out. We're trying to make things better. But I think the short answer, especially as we're developing new tools that the industry itself is becoming more familiar with, all the help that we can get to educate borrowers and drive engagement to servicers is always appreciated and valued. But
yeah, look, I'll throw this in. Being the youngest member on the panel, I probably have the least experience in this situation, but I'll tell you, housing counselors are key to these solutions. And even though information is better, websites are better, scripting is more reviewed, all these things are better than they were in the past, there's still a certain amount of people who are still uncomfortable, and they might turn to something more local, or they might turn to something more neutral in their mind to get that advice that's needed. And it's been proven over and over and over that homeownership counseling, whether it's pre or post lending, is positive and good. It's critical as we continue to complicate the loss mid scenario. It gets more and more complicated. That there is a mechanism to educate and keep these counselors current, because they are going to have, in many cases, the one conversation that the homeowner trusts. If they give information that's outdated or incorrect, or they don't know about new programs, then we all miss an opportunity for somebody to avoid making a mistake at that point. So it's critical that be included, both in getting information from counselors on what they're experiencing, what kind of gaps are from their mind, and then in training them as we go forward.
Steve said it really well. I agree. Good question, though.
Okay. Let's see. Do we have time for one more question, or should we break and go to the next panel? It's kind of a lengthy question.
What's the question?
It's about the credit profile of a borrower who has a second lien due to forbearance. That wouldn't be equal to a borrower who's missed a payment from the credit reporting perspective. So they're asking, if you had a long-term second lien risk to the government, the scale would be hard to size up. Would it make sense to force a borrower to refinance and repay the amounts when rates are low, or hit a trigger, rather than keep the second liens in place for 40 or 30 years?
Yeah, I can answer that quickly. If a program allows you to miss one payment and refinance at a better or similar rate, you would do that. The problem we're having right now, following the first panel, is that's not available right now, and it's not going to be available for a while. But certainly, rather than to going through all the gyrations of a second lien and all of the machinations of keeping that going for all that period of time, would be worse than you're going to miss one payment and refinance to a lower rate.
So I didn't actually read the question, but it sounded like that there might be another nuance to it, that they're questioning whether a borrower having a subordinate lien sort of on as an outstanding obligation is a negative situation for them, and whether or not there should be a mechanism by which the borrower can get out from under that subordinate lien. But the interesting thing is that the government subordinate liens are zero interest bearing subordinate liens, so that it's actually in the interest of the borrower to have had some amount of that outstanding balance or those accumulated arrearages put into that subordinate lien, because it is not accruing interest and it is due on payoff of their loan or sale of their property. And in cases where it's the sale of the property, for example, and they cannot, the revenue and proceeds from the sale of the property are inadequate to pay off the subordinate lien, the balance that they can't pay is actually forgiven. So those subordinate liens are actually designed to be extremely consumer friendly, and there probably isn't any need to force a refinance payoff of that subordinate lien to preserve the borrower's interest. They're in good shape having that subordinate lien.
All right, I think that's all we have time for today. So I want to thank everybody for weighing in on all of that. And I wondered if we could break now and move into our next panel.
Thank you very much.
Excellent. Thank you.
Thank you.
Could all the speakers for the next panel please turn on their cameras? Okay, for those who are tuning in now, I'm Bonnie Sinnott, Capital Markets Editor of National Mortgage News. And with me today are Lisa Sitkin and Vanessa. Are you out there? She is. Okay.
Yes. Oh, yeah.
Okay, great. So today we are going to talk about the question of the consumer perspective in all this. And Vanessa Gale Perry is a non-resident fellow at the Urban Institute's Housing Finance Policy Center and a professor at George Washington University School of Business. And Lisa Sitkin is the senior staff attorney, National Housing Law Project, and they're going to help guide us through this topic. We don't have a lot of time, so I want to move into this quickly. And as we prepared for this panel, I was thinking about how tough it is to juggle all the financial considerations involved when an unexpected hardship occurs. I was thinking, in my case, suddenly there was one day I couldn't live in my apartment for 13 months because I'd had a fire. So I'm going to ask our panelists to talk about how to understand the borrower mindset when a crisis occurs and what to consider in communicating with them. I'd like Vanessa to start on that topic, and then we'll circle back to Lisa for the question, which we kind of touched upon in the earlier panel about how the legal and regulatory issues play into those communications.
Okay, well, thanks, Bonnie. I'm delighted to be here and have the opportunity to sort of speak to the consumer experience with loss mitigation. Improving the FHA waterfall and some of the topics that came up in the first panel with respect to the payment supplement accounts. These kinds of advances will have a significant impact on keeping borrowers in their homes. And I'm particularly focused on sort of Black and Latino and other historically disadvantaged communities. And so the only way to really make this happen is to alleviate the burdens on servicers and issuers by simplifying processes, by aligning the regulatory requirements, if not fully standardizing, at least creating similar options for all agency mortgages. And I agree with something that Kurt pointed out in the first panel, which is that consumers really need to understand the terms of these things like partial claims, et cetera. It's worth noting that borrowers who are Black or Hispanic already pay more for homeownership. Research has shown that these borrowers pay higher interest rates and fees, which means they have lower levels of equity accumulated. There's also some recent evidence on racial disparities in home valuations. And so these errors can complicate loss mitigation efforts by affecting the terms of loan modifications. These borrowers are less likely to refinance into lower rate products. And so and there's evidence that these borrowers were also more likely to miss out on forbearance opportunities. The subject of the last discussion in the prior panel was about that. Many of these borrowers were more likely to be needlessly delinquent, as I think some of my urban colleagues described that situation. In economic downturns, historically, these communities are the hardest hit. And many of these circumstances are outside of the borrower's control, just like the pandemic was. And so I agree with my colleague, Lori Goodman, and her co-authors about the idea of sort of normalizing hardship forbearance. So that's just sort of background, but the question was about sort of the consumer mindset. Anecdotal evidence suggests that there's a lot of confusion, there's a lot of misinformation, and really a lack of outreach that has had grave consequences for homeowners and stands to have even worse consequences for homeowners, for communities, and for the economy. The truth is, the only thing that matters to the borrower who finds themselves in trouble is how to cope with the immediate crisis. And Meg Burns, on the second panel earlier today, talked about the importance of connecting the borrower with the borrower at the outset of their hardship and establishing contact. Well, we know from the body of literature on decision-making under risk and uncertainty that these circumstances are probably the worst conditions for making careful and informed decisions. Borrowers in trouble may or may not be able to predict whether they have temporary or permanent or short-term versus long-term needs for loss mitigation kinds of interventions. And the implications are confusing, even to many of us who are supposed to understand these issues. So people make choices under these circumstances by taking shortcuts, right? They use decision heuristics like, how do I minimize my monthly payment? So how do we help people make decisions under these situations? Well, research tells us to rely on choice architecture, the theory that actually drove some of the Dodd-Frank regulations, for better or for worse. And the idea there is to streamline the choices with a number of simple alternatives and make those options that are potentially harmful or the highest risk the most difficult to access. So Meg pointed out in the second panel that people have talked quite a bit about automatic forbearance programs and how this could be detrimental. And while we want to be really careful about imposing automatic choices on people, we could impose automatic provision of information about choices. And we can do that using the most effective media tools that we have available to us. The other takeaway from research on consumer decisions is that we know that the crisis is actually the worst time to evaluate new information. And so we can't afford to wait until the crisis ensues. So here's my favorite example of this. I bet everyone in this webinar knows what to do in case of an emergency water landing on an airplane. Why? Because it's been drilled into our heads on every flight. Most people can recite it, whether or not they've paid attention to it or not. So when people aren't likely to pay attention, repetition is a proven approach to educating consumers. So we need better outreach that is ongoing, that is repeated, that is targeted, and that is deliberate. And there are plenty of tools available in the digitalized world to facilitate this. One idea that was just mentioned earlier is to partner with the HUD network of housing counselors that could help us figure out how to best convey these details once the details are figured out. And then last, I'll point out that since the industry has recently turned its attention to special purpose credit programs, perhaps we should think about special purpose loss mitigation programs that are designed to serve historically disadvantaged communities. I'll stop there.
All right, thank you. Lisa, I wondered if you wanted to talk now about kind of how you have to navigate the regulatory framework in communicating with consumers.
I will talk about that, but I want to start a little bit somewhere else just to pick up on a couple threads that have come up in the previous panels and in some of Vanessa's comments. I'm all for the special purpose credit program in loss mitigation, so that was on my list. Thank you, Vanessa. I guess I want to say, and I honestly wish we had more time for this piece of this whole discussion, because I think it's really, really critical. It's where the rubber hits the road, or whatever metaphor you want to use. I think that there are a number of regulatory changes that would help whatever direction things go substantively in terms of, forbearances becoming more regularized, and particularly streamlined options, which Meg brought up, which I think are a key to actually moving people through these systems. We know that, all of the documentation was a nightmare on both sides of the equation. So I think there are changes that need to be made to address those things, but I would like to talk about, as somebody who, worked with homeowners and servicers directly for about 9 years during the whole foreclosure crisis, and I now consult with other advocates who work with them. I really want to echo the critical importance of robust integration of housing counselors and other third parties. There are a lot of legal aid attorneys who also work with homeowners in these systems. And I saw in the Q&A already somebody asking a question about, or making the point that it would be really useful to have servicers provide education and training and updates to housing counselors directly. And I think that that's true. Far too often things sort of have to filter down as opposed to getting directly communicated. But I also think that, and I think people on this call know this, that, the servicers work hard, and I know they do, to communicate effectively, to, do outreach and all of that. But the reality is that there are a lot of borrowers, particularly in communities of color, but across the spectrum, who are just distrustful of their servicers, or who find the scripts that they often encounter when they talk to servicers to just be sort of impenetrable and not particularly useful. They do need somebody who's going to be able to sit down and look at their situation holistically, talk through the specific realities of their situation so that they can make informed choices. And while not every single borrower is going to work with a housing counselor, I sort of think that should be our kind of lodestar goal, that's what we're going toward, is that people should have this kind of outside counsel be available. So I think, for both forbearances and for streamlined options that I think are a big part of the future of loss mitigation, there are regulatory changes that those of us in the consumer and homeowner advocacy community really see as critical to making sure that borrowers are still protected in those processes. And we've put those, I'm not going to go through in great detail because we don't have time, but we my organization and NCLC and CRL have submitted, responses to the CFPB's RFI about that. And with respect to streamline options in particular, we're very interested in seeing more protection in terms of written offers and denial notices, appeal rights, actual dual tracking protections, because that has been lacking, and the option to keep those options open, even if you're going to be reviewed for something else. And, it's complicated. I realize that. I'm not saying that any of this is simple, but I think that those kind of protections are really necessary to make the system overall work for homeowners and to keep them, able to keep their homes. A few other things I just want to say on the servicing side, in terms of, practices. I think that, what we have been seeing during COVID and before it, but during COVID, as changes were happening so fast for everybody, is that, training often didn't exactly keep up, and it's a challenge. But making sure that the people talking to the borrowers on those front lines have an understanding beyond what's in a given script is really, really important. It just doesn't serve either the borrower or really the servicer, because they're going to have someone keep coming back or keep cycling through defaults if they don't understand. So making sure that those frontline people really are trained, really are capable, really also are not siloed, that they're actually connected with the different departments, the escrow department, the loss mit, the foreclosure, and now that we have something like HAF, those being integrated is really, really important. And also that the people who are talking to borrowers have easy access to information. I know a lot of these systems are old and probably need updating, but it's just shocking to me sometimes that somebody who, from the borrower's perspective, is the face of the servicer, right? Should have the whole run of information that is needed, will have only a piece of it. And then you're being passed to other people or being given wrong information about another department's kind of responsibilities. And that really is just a recipe for people falling between the cracks or kind of disappearing. I mean, there's concern about borrowers not being responsive, but sometimes it's because of that, because these calls can be incredibly frustrating. So minimizing that, really important. And then in terms of the communications, I think that, somebody, I think in the panel 1 talked about having, kind of common, consistent wording, especially for something as complicated as the proposal talked about in the first panel. And that maybe the CFPB, would be sort of the right kind of original drafter of that. But I also really, really would ask those in the servicing community. I know that, when you're coming up with the materials that are going to go to borrowers, you have to have them go through legal, and there's always, all of these different iterations of them. But please consider utilizing homeowner advocates and even homeowners as part of that process, as a regular part of that process, because I look at these letters every day and I know people are working hard on them, but so many of them are just completely opaque. And it's true that, having something in writing is really important, but it needs to be something that the person understands. I mean, I think we can all agree on that. So that's just something that I think could really make a huge difference, especially as rules change and these things have to be updated going forward. And then I want to say, I think, and this sort of goes to what Vanessa was saying about repetition, but it's a little bit different, which is, I think we need to also be thinking in terms of getting ahead of these crises, right? Disasters are happening more and more frequently, hurricanes, wildfires, where I am in California. And COVID, something like COVID may not happen again for a while, but it probably will happen in our lifetimes even. And I think that taking the time for all of the stakeholders, and I know, Urban did a great job in the beginning of the crisis of bringing many of us together to have these discussions. I think those, if possible, should be ongoing and regular, because, when we set up the Homeowner Assistance Fund, which is what I work on a lot these days, there was so much that if there had been sort of ground laid beforehand by the stakeholders who really have something to contribute, and lessons learned from hardest hit funds and things like that done in a more systematic way, I think we would have been better off, and a lot of the complications and challenges that are being encountered by borrowers and programs in that program could have been avoided. So I think I am engaged currently in kind of doing a day-to-day autopsy of HAF as it is happening in real time. But I think that having some time set aside for attention and discussion of how these programs are really going to kick in when the disaster happens, as opposed to always playing catch up, which we all always seem to be doing, would really be of service to consumers and help people to keep their homes. I'll stop there for now.
All right, thank you. I think we were going to leave a little time for Q&A, and I know we've got at least one question. It's about pre-purchase counseling. To the extent that's a prerequisite for most, if not all, first-time homebuyer programs, could loss mit counseling be a prerequisite as well? The thinking the questioner has is, the sooner in the process, the better. So what's your thoughts on, could that happen?
I think that's a great thought. Yeah. And I think in particular that, making sure that people know, I mean, especially if the forbearance proposal or some version of it goes into effect, the idea is that people could actually ask for that before they become delinquent. When they see this, they are getting divorced or somebody is in hospice, let's say. I mean, they know that this is coming and they want to ask for the help. The only way for them to know about that is notices from the servicer or having learned about it, at some point in the process of getting the loan. So I'm in favor of that. Vanessa, sorry, I'll let you.
No, I'm also in favor of it. In fact, when I think of pre-purchase counseling, what I really am thinking about is loss mitigation counseling. Because what else do you really need to know, right? I mean, you're gonna, the underwriting process has already let you know how much you're going to have to pay. And so really what you need to know is what happens if you get in trouble. And the point I was making earlier about the repetition is that there should be information presented about the availability of options all the time in every communication with borrowers. I mean, let's face it, a lot of people have automatic payments taken. They don't even know who their servicer is. I think it's 38%, I just read, of people don't even know what their interest rate is. So there's a lot of so there's not a lot of opportunities really to be able to reach borrowers. But when we do, we should remind them that, hey, if by chance you foresee having trouble making payments, this is who you contact. And just repeat that and make sure that that's available so we don't have to wait for a crisis to ensue, because people are usually pretty poor about sort of predicting what might happen to them, especially if you're subject to sort of, negative external events. It's just not the time to make the best decisions. So let's make that for them. When I say make the decision to contact someone for help is really the only decision that needs to be made. And then that counselor or that servicer can refer them to a counselor or whatever, they can sort of take it from there. But my fear is that a lot of people don't have any idea that these options are available. And so they think things are going to go from zero to a foreclosure. And so embedding this kind of information in pre-purchase counseling and then every other opportunity we have to reach borrowers, I think is a great idea.
And that kind of feeds well into our last question for today, which is restate it quickly, is kind of comparing the problems we saw in the 2008 crisis, where you had the delinquencies going to foreclosure without right party contact, compared to what we saw in COVID forbearance. The solution was widespread, but have the instances of unresponsive borrowers improved overall in the latest crisis? And do we see demographic differences in borrower communications? I don't know if either of you can speak to that. I think that's an interesting question. Maybe it's one we have to look into.
Yeah, I don't have the data on it specifically, and I'll use that then to make the point that data collection in this area, I think, FHFA has made this point in, some of its recent materials that data collection about loss mitigation and, should be more of a priority, which I agree with, but I think it needs to be really granular. It has to be about, borrower response rates. It has to be about actual, the transition from forbearance to a resolution, if that is what's happening, and what kinds of loss mit different people are getting. I think, without having the numbers, that in my anecdotal experience, obviously people who have, language access issues or disabilities that make it harder to contact, particularly online. Seniors in particular, there are a lot of groups that really do need the extra lift of housing counselor or another third party to help them make that connection, or a community-based group that's plugged in. So as we look at those numbers, I think it's really important to keep those the demographic considerations in mind, and be tailoring outreach and communications to really make sure that we're covering everyone who's out there and has the need.
All right, it looks like that's all we have time for today. I want to thank all the panelists and attendees who have joined in our discussion, and turn things over, I believe, to Haley for any closing remarks.
Thank you, everybody, for joining us today. It's really been a discussion that feels to me like the tip of the iceberg, and that could go on for a long, long time. We had some extraordinarily good questions and answers. We haven't even gotten to all of them yet, but we will definitely be taking all those questions into consideration as we continue to advance this conversation. A reminder to fill in the survey if you can still find the link in the Q&A that Bonnie has put up. And thank you all very much for joining us today.